In March of 2010, the Jamaica Deposit Insurance Corporation, JDIC, staged the first Caribbean Bank Insolvency Conference at the Rose Hall Resort and Spa in Montego Bay. Over 20 experts from countries across the Caribbean, Canada, the United States, and United Kingdom spoke on issues relevant to the global financial crisis, international initiatives towards best practices, and resolutions for bank insolvency. In today's episode, we'll feature the presentation made by Executive Director of the Deposit Insurance Corporation of Japan, Yasuki Kawakami. He addressed the issue of bank nationalization and reprivatization in Japan. You'll also hear from Donald McKinley, Regional Counsel for Dallas for the Federal Deposit Insurance Corporation. Mr. McKinley spoke on the topic of when deposit insurers or regulators take over, the experience of the USA with reference to interventions during the recent global crisis. Yasuki Kawakami is the Executive Director at the Deposit Insurance Corporation of Japan, DICJ. He's on secondment from the Japanese Ministry of Finance, to which he's been employed since 1983. Mr. Kawakami has lectured at the National Graduate Institute for Policy Studies, Seoul National University, and the University of Tokyo.
In Japan, we've had full nationalization of long-term credit bank, Nippon Credit Bank, Ashikaga, that's a regional bank, but that also required government intervention because of a systemic risk concern, at least for the regional economy. Japan is also a capitalist society, so we don't believe that these nationalizations are desirable. We firmly believe that private sector should be the main financier in the market-based economy. So the purpose of government intervention is to avoid market failure, and of course, bloated state banks are not preferable in any case. But as many people have noticed, we have this acute problem of too big to fail, and the troubled banks are temporarily or partly nationalized as a necessary evil, or in case of, in the words of other speakers this morning, as a last resort in excess of the deposit insurance coverage limit. The lesson that I'm going to talk about, the failure of long-term credit bank in 1998, thus triggered a harsh debate in the subsequent parliamentary discussion between the government and the opposition on how and whether or not to nationalize this very large bank. And the first question that was asked was to fail or not to fail, whether to let LTCB fail or prevent its failure because of systemic risk concerns. And the second question that we had, well, the parliamentarians were asking were how to pursue management responsibility for the failures. And then the third issue that came up this morning was to whether or not to have shareholders take some of the responsibility. So in the final end, the financial revitalization law was enacted in Parliament to stipulate the rules for temporary nationalization of troubled banks, which we didn't have. I'm going to now go to the sort of the more concrete case study on the nationalization of LTCB in 1998. Which was subsequently reprivatized in 2008. I should say, I should qualify that as partly reprivatized because we still hold shares and we're not able to fully exit after 10 years. The misfortune of LTCB began with the slowdown of Japan's economy in the 1970s. And of course, disintermediation took place in Japan like the other industrialized countries in the world. Now, when the Japanese bubble burst in the early 1990s, of course, there was a sharp increase in NPLs, for instance, to their group companies, and there was a vicious circle of poor credit ratings, sharp declines in stock prices, and liquidity problems. We did not think that it would be possible to allow this bank to fail, for fear of aggravating not only the Japanese domestic financial situation, but exporting the problem elsewhere to Asia and around the world. What's the content of this nationalization or special public management? The DICJ acquired the shares But I think we talked about this morning, but we had a third-party commission, independent commission, assess the share value. As this commission determined that the LTCB was insolvent, the residual value was obviously zero, so there was no payment, the compensation that was conferred upon the shareholders. The DICJ and the government undertook management changes and liability pursuits against ex-executives. The DICJ also provided an emergency loan for liquidity management. We also value the assets, separate the non-performing ones, and the non-performing loans were bought by our subsidiary, the Resolution Collection Corporation. What are the sort of measures that were taken towards exit? We selected the purchaser, and conclude the sales contract. We provided monetary grants, the compensated for the losses, and some of the assets were acquired by DICJ, and the final sale was conducted in March 2000. So this is the sort of our assessment of nationalization. Well, of course, critical financial functions were maintained. Depositors and good debtors were protected. We prevented the systemic risk by protecting financial contracts. Right now, we're talking about credit default swaps, but in those days, CDS didn't exist. But for instance, the treatment of swaps was somewhat ambiguous under the then existing rules underwritten by ISDA. So I think by rescuing LTCB, we prevented systemic risk from being exported. You might remember that LTCB had 34 branch offices around the globe, and the treatment of these swaps could have been very problematic. Anyway, we managed to stabilize both the domestic and international financial markets, and as I said, we prevented the systemic risk, the exportation of systemic risk from Japan to the rest of the world.
Donald McKinley is Regional Counsel for Dallas for the Federal Deposit Insurance Corporation of the USA. Mr. McKinley's responsibilities include banking law, bankruptcy, and commercial loans.
As Regional Counsel in Dallas, Texas, I head up an office of about 100 people, and right now we're responsible for all the resolution and receivership activity, whether it's in Hawaii or it's in Florida. Our primary area of responsibility as FDIC is to provide deposit insurance to banks and savings institutions in the United States. That's mission one, and that's a mission we take with a lot of pride in. Since 1933, no insured depositor has lost one dime of their insurance money, and that's a creed that every FDIC person learns, lives by, and honors that tradition. It's a cultural thing with us, in addition to a public confidence issue. FDIC's primary responsibility is to supervise state-chartered non-member banks, and in addition, my role acting as receiver for failed banks as they develop in thrifts, and then, of course, liquidating the assets of those banks. There were years that went by, we had absolutely no closing activity whatsoever. 2007, we had a total of 3 bank closings. But in any event, 2008, go up to 25 bank failures. All of a sudden, 2009, we have 140 bank failures in 2009. Last week through Friday of 2010, we hit 37. The first thing that we talk about on the resolution objective, and so many of the other speakers pointed this out, provide our depositor customers timely access to their insured funds. I mentioned that 77 years. What does that mean? Quite often it means the very next business day. General parameter, no more than 3 business days. But our general practice is we turn it over in 1 day. We are ready to go. When we talk about resolving failed institutions in the least costly manner, We now have assets, our book value of our assets that we've got to now liquidate through, totals up approximately $39 billion. And we have about 224 receiverships that we now have to manage and generate recoveries out of those receiverships. I want to point out that when we administer receiverships, and this has been alluded to by other speakers, by federal in terms of our own FDI Act, there is a priority mechanism by which we do that. Secured and preferred creditors get paid first. Administrative expenses of the receivership come. Then we take care of the depositors. FDIC tends to be the largest depositor because when we pay out on deposits, we end up acquiring a subrogation claim. At times, there are uninsured depositors, and of course, we pay those too. So we're paying pari passu with the depositor class. After the depositors are fully paid, then come the general creditors. After the general creditors, then come the subordinated debt holders. And after the subordinated debt holders, anybody want to guess who comes next? Shareholders. We're confident that we've got the liquidity, we've got the fund balance to go ahead and support our resolution activity. And so in order to further support the fund, there was a special assessment that netted about $5.5 billion. And then on top of that, FDIC afforded banks a prepayment opportunity to prepay their risk-based assessments through the year 2010, 2011, 2012, and that generated another $45.7 billion. The way we become receiver is it depends on the regulatory authority. If it's a national bank, the Office of the Comptroller of the Currency will be the party that determines whether the bank is insolvent or should be placed into receivership. Once they make that determination by federal law, FDIC will serve as that receiver. We have the ability to self-appoint as receiver ourselves, and we've used that authority at times. And one of the responsibilities we have as receiver is, of course, to value the assets and then to go ahead and distribute the assets. One of the things that we have as a receiver are certain superpowers. It's amazing how several of these actually work for the benefit of the banks that are acquiring our failed banks. For example, a superpower might be the ability to affirm or repudiate contracts. We have the ability to deal with unwritten loan agreements. We have the ability to kind of centralize and be exclusively accountable. But indeed, part of our powers and part of our authority is there's an administrative claims process where parties generally have to bring those in for our review first, hear what our determination is. We get a chance to evaluate what either the bank did or what we're doing. And if we turn out we deny the claim, then they may pursue it on into litigation. What we have found is that because of the type of assets we're running into and some of the operation issues that we run into, it is very necessary to coordinate and function as a team. One of the things that FDIC did do to try to help stabilize public confidence in the system was the Temporary Liquidity Guarantee Program. It came out in 2008. This has actually been a revenue maker for FDIC. The most common way for FDIC to deal with failing banks, resolution strategies, what we've learned is this: timing, early intervention. As a deputy once said to me, knowledge is power. So with early intervention, early interdiction, cooperation, what we've done is the vast majority of our transactions have been what we call whole bank purchase and assumption transactions with loss share. Or at times we will do transactions with a limited where we're selling assets to a partner that we create, an LLC. The more we have in the flexibility in terms of our legislative abilities, the more opportunities we have to make those objectives real. Timely payoff depositors, minimize any disruption, and administer those receiverships in an effective manner.
In our next episode, we'll bring you highlights of the presentation given by the Senior Legal Counsel at the Bank of Jamaica, Robin Sykes, and President and Chief Executive Officer of the Canada Deposit Insurance Corporation, Guy St. Pierre.